Hi, everyone. Welcome to the ABF Journal Podcast. My name is Rita Garwood. I am editor-in-chief of ABF Journal. Joining me on the podcast today is Anthony Arnold. Anthony is chair of Barnes and Thornburg's private equity practice. Anthony, thanks for being on the podcast today.
Of course, happy to join you from, well, not so sunny San Diego, but I think it'll burn off and should be sunny a little later.
So for listeners who might not be familiar, today we're going to be talking about private equity carve-outs. And for those who are not familiar with the topic, how do you define a private equity carve-out and why is it gaining attention right now?
Yeah, it's a great question. So carve-outs are distinct from your normal leverage buyout that private equity funds are known for because they're more granular, right? You're not buying an entire business, you're buying a portion of a business, a division, maybe just even one product line, essentially whatever the buyer's interested in carved out from the overall business. It could be a subsidiary, it could be part of a subsidiary. So there's many ways to slice and dice it. So carve out is, I think, generally applicable as an umbrella term to all those things. But generally, we use it as a, portion of a business that a seller no longer wants to hold in combination with the other businesses, and the private equity fund is taking it and either adding it on to an existing platform or using that to build a platform that then they will grow as an independent business.
And it sounds like we're seeing more of those happening today. Why is that?
100%. I think, first of all, we have more private equity funds, more investors coming in generally. So they're seeing opportunities in the market like carve-outs that haven't been traditionally part of the investment mix for them. I think a lot of sellers are looking at, kind of streamlining, focusing on their core businesses, especially with some of the regulatory changes that may change, the returns they're seeing or the cash they're generating from, businesses that they haven't traditionally been focused on. Yeah, and I think it's always kind of been there, right? Where you have businesses that are either streamlining or need to shore up the balance sheet. But I think now it's, much more traditional, much more customary to have these carve-outs as a deal, right? As opposed to being part of a deal. So I think that's why we're seeing more of them.
So we've been hearing a lot about record levels of dry powder recently. How is that influencing private equity firms target carve-out specifically?
Yeah, it gives them the resources to do carve-outs where they can essentially buy larger parts of a businesses that they may be interested. So, parts of a combination of a business that that work together that they can then grow. I would say it makes it more competitive. So carve-outs either, in a sale process where you have a banker running an auction, right? You have more people throwing their bids in there. And essentially, I think the dry powder is making it such that carve-outs are attracting more attention, but also the valuations that you're seeing for carve-out businesses is a little bit higher as a result of the dry powder. I think the idea is also when you have a carve-out, part of the play for the private equity fund is buying the business, but also what happens post-closing, right? To drive the value of that business and improve it operationally, improve it financially, to grow it either, organically or through acquisition. So the dry powder, is not only at the initial acquisition, but how do we deploy capital going forward to make the carve-out successful, the carved-out business successful and work well independently after closing. So I think the dry powder gives private equity more funds to play with at closing, but also post-closing to make the changes they need to improve the business and make it successful.
Makes a lot of sense. So we are in a higher interest rate environment right now. It has been going on for a little while. But even though we're in this environment, you've noted that financing remains accessible for these types of deals. Are private credit funds and banks playing different roles in funding carve-outs than in other types of deals?
Yeah, I would say it's much harder for banks to get their arms around balance sheet for a business that's never had its own balance sheet, right? The carve-out balance sheet, I think, is something new to them. I think this idea of essentially a business that, is kind of tracking what the prior business did, but was relying on potentially other operational assets or other, financial internal assets that are not moving with the business. I think they're a little bit less comfortable with that. So I think private equity funds have really stepped up, or sorry, private credit funds have stepped up to fill the gap because they understand, these kind of carve out balance sheets, what they look like, and they have a little bit more flexibility in terms of structure and the terms that I think make it attractive for them to partner up with the PE funds that are doing the carve out deals. But yeah, there is financing. It's just, I think, a little bit more again, granular in terms of what they're looking at on the credit security side, right? So the assets are, you have to look down a little bit further than you would in a traditional LBO. It's not just financing the entire business, it's financing, particular assets, which I think is a different ask for the banks and credit funds than it typically would be.
Definitely. So the conversations that you've had with corporate sellers who are in these situations, what are the top reasons that they're deciding to spin off business units and take this approach?
Yeah, some of them, there's many reasons. So we see a lot of sort of failed acquisitions, right? Where maybe the corporate buyer seller was a corporate buyer previously, bought a business they thought would be complementary or synergistic with their existing business, and they gave it a little bit of time to prove itself out, and it just hasn't been. So they've decided, right, at that point to offload it and cut their losses and move on and focus on the core business. We see that a lot. We also see, I would say, again, streamlining, focusing on core businesses, just changes in the overall market based on secular trends, right? So businesses that are no longer generating the kind of cash flow they did before. I think private equity funds and corporate sellers work together to kind of identify those, right? Where maybe the corporate seller no longer has an interest in focusing on that business division or that line. And the PE funds see value there, right? They have a plan post-closing to make it valuable that the corporate seller just can't implement. So I think that's essentially where we see a lot of opportunity for the PE funds and why they're doing more carve-outs. Corporate sellers just, I think have fewer resources and aren't able to focus on the operational changes, financial changes, kind of creative structuring that I think the corporate sellers are able to, sorry, the private equity funds are able to achieve.
Hmm. Um, can you kind of outline the differences between, from a PE firm's perspective, the opportunities that exist within a carve-out that they might not have in just a traditional acquisition deal?
Yeah, I think the ability to be very picky about what assets they are acquiring or not acquiring, ring fencing liability and leaving it with the corporate seller, because from a legal standpoint, we're always worried about successor liability. But in a carve-out scenario, it's much harder to make the argument that you're going to inherit liability based on certain assets you're acquiring because the existing seller is still going to stay in place, right? So that's the business that should stay with the liability. And so it's a lot, it makes the legal documentation a little bit trickier because you have to be more granular, but it's also better for the buyer, I think, to have that very clear segmentation of assets, liabilities, what's excluded, what's included. And yeah, we see that a lot. It makes the lawyer's job a little bit harder, but also more important.
Yeah, for sure. So can you share a recent example of a case, you don't have to name names or anything, where
Mhm.
a carve-out generated strong returns through operational improvements or strategic repositioning that you've been a part of?
Yeah, so we work with a PE fund based in Los Angeles that has invested in, let's say, companies that have legacy brands that most Americans would know and recognize, mostly in the consumer product space. Some of those brands have diversified their businesses, and the core, kind of prior core business, the legacy business, just hasn't generated the kind of cash returns that the newer businesses are generating. So the corporate sellers are realizing, okay, it's better for us to focus on what's actually generating the cash now. Let's offload, what we're not really focused on and what's kind of, dead weight to us or dragging us down from a financial standpoint. And so we've had a couple deals in the last year like that where really strong bands, like I said, they'd be household names. PE funds are coming in, swooping them up, buying them. And I think they see a way to take an association with that brand just because it does have value and build from it in a way that the corporate seller is not able to do.
So if you look out across, all of the different industries where you're seeing carve-outs, do any in particular stand out for the amount of activity you're seeing, and what makes certain industries attractive for this type of deal?
Yeah, I think I mentioned consumer products. That's one just because tariffs and sort of supply chain issues, right? I think that's an area where PE funds see value because corporate sellers are very sensitive to what's changing. It's hard to know what's changing, what's coming down tomorrow or even later today, right? And I think, PE funds have a little bit more of an ability to not necessarily anticipate, but to build around and protect against the risk there. I also think, healthcare is another area where we see because of regulatory changes, because of just changes in the way folks are consuming healthcare. We've seen a few carve-outs there. Really successful, practices or products I think are generating a lot of attention. And there's some, healthcare businesses that I think are suffering just generally that are maybe going to be insolvent at some point that are looking to kind of generate the cash to stay afloat. So that makes it attractive for PE buyers. I would say still sort of industrial products, kind of similar to consumer products, is another one where, because of the tariffs and supply chain issues, that is driving, potential deal flow. So those are the industries we're seeing most of the action.
So how about for the rest of the year? What's your outlook for carve-out activity through 2025 and into 2026? And
Mhm.
what should PE firms and lenders just be preparing for here?
Yeah, I think generally deal flow will be higher. Just, from anecdotal experience, our summer's been incredibly busy, including with carve-out activity. The first quarter was, I would say, unusually slow. It wasn't shockingly slow, but it was a little slower than we anticipated. I think just because people wanted to settle in the new administration, changes in the economy, what's happening, with the global markets. And I think now that it's settled down a little bit, folks are issuing, letters of intent, term sheets, they are doing deals. So I would say for me, May, June, and July were probably some of the busiest months I've had in my career. And I think it's going to stay that way for the rest of the year, just based on what we've seen from clients so far, reaching out to us with new deals that they have, at the LOI stage or even earlier, right? Saying we're looking at participating in this process or issuing a term sheet, for this business. And so I think deal flow will continue to remain very active. And there's still lots of opportunities there. Like I said, there's lots of corporate sellers who have bought businesses that just haven't panned out. And you kind of see that in, some of their, their valuations or their stock prices. And I think that's kind of the low-hanging fruit for the buyers.
Well, thank you so much for answering all these questions and talking to me about this. Is there anything else that we didn't talk about that we didn't hit about this topic that you think is important?
Yeah, I'll say one of the things that I think makes private equity buyers, I think particularly interested in carve-outs is the ability to um, put together, I would say, a plan post-closing, right? I think we talked a little bit about why corporate sellers are doing carve-outs, but buyers in particular, again, are taking a granular view of what services or assets they can essentially, segregate from the existing business. And so part of our job, on the legal side is really crafting transitional services agreement there's still a relationship oftentimes post closing between the carved out business, so what our buyer buys, and the seller business, right? So we have to have post closing support from the seller, either on the operational side, accounting, sometimes IT even, especially if these standalone businesses have never had those things independently. So I think PE funds are focused on that because there is value there, right? There's the ability to both leverage, kind of what's in place currently with the corporate seller, but also to improve on that and really find more efficient solutions, a better way to do things for the carved out business going forward. And I think that's really where they're generating the alpha and the returns for their investors. So that's why carve outs are, I think, interesting to them and why they'll continue to do them.
Right. Well, thanks so much for being on the podcast and sharing all your knowledge about carve-outs. We appreciate it.
Of course, let's see what the rest of the year holds in store for us.
Thanks so much, Anthony.
Thank you.